Good morning, guys. Hopefully my presentation will pop up on the screen shortly. Right, guys, as Ralph has said, there are two schools of thought when analyzing whether or not to invest in a certain product or instrument. The two schools are fundamental analysis and technical analysis. Now, you've just gone through what fundamental analysis is, and technical analysis is not simply just looking at charts and graphs, because I'm sure to many of you that just looks a little bit difficult, and what are you really looking at? But I'm here today to show you that this is not rocket science, and this doesn't take a lot to understand, because all technical analysis really is, it's historical data of the price movement and the momentum or lack thereof of the price. So when you're looking at possibly investing as an individual or even as a club, you can get a very basic technical analysis software package from any reputable stockbroker for free. You don't have to go and pay these exorbitant amounts of money for technical analysis software. But all you're doing is you're looking at the history of the price, the movement of that share price, whether it's going up or down, and the momentum. And I'm going to show you how easy this really is to understand. And by the end of this, hopefully you guys will all be able to read a chart. And then I'm going to show you what you, as a collective or a club, should be looking for when you're buying or deciding to buy or invest into certain stocks or instruments. Okay. So just to give you some background or a little bit of a heads up, there's so many technical strategies. I personally am a technical trader. I use technical analysis purely for the purpose of trying to establish where I'm going to get in and where I'm possibly going to get out, because that's important. Okay, because many times you are wrong. Prices move, and you just need to try and establish, once there's a bit of fundamental analysis that comes through from analysts, and they say this is a great company. Now what do? I've just been told it's a great company. Where do I buy? Is this company cheap? Is it expensive according to the analysis, the fundamentals? But now I really want to buy this company. So where do I get in? And this is where I look at my charts. Okay. Now, just to give you an analogy, a fundamental analyst will walk into a spa and look at, let's say, 2-minute noodles. And he will prefer Koo 2-minute noodles because of their dietary components. They're much better for you. The packaging looks more attractive. More customers are going to see this package on the shelf as opposed to Maggi 2-minute noodles. But a technical analyst is the guy who stands at the door and sees who's walking out with the most noodles and what noodles are being bought. And that's what we like to buy, because it's all about price and momentum. Okay, so you get many technical strategies. These are some of them, which we'll go through. Break trading, for example. You're kind of looking for any price action that has changed whatever the share has done. So normally a break trade would be something like this, where a share has traded in a certain range, all of a sudden made a new high, then popped up to make new highs, and all of a sudden it's broken out into a new range. Okay? Similarly on the bottom, so now you've got a long-term investment and you're not sure how much longer do I have to hold this thing, but you kind of know that, when it's made new lows, hopefully these new lows last, but when it breaks through a new low, you're probably going to sell out of that share because now it's broken, and that's break trading. The shorter term guys would short that share and make money on the way down. However, that is not the exercise you are participating in. And then range trading, for example, you guys are looking for a longer term investment as a club or a Stokvel. You want shares that are going up. So typically you wouldn't be looking for shares that are trading in a range. You want shares to go up. Now, shares don't always go up, and they don't always go down. They kind of sometimes get stuck in between. And there's a perfect example. Like if a share is trading at $100, and every time it gets to 105, people just start selling. And it's quite frustrating for a longer term investor, and that's normally where they just bomb out and normally creates a break on the other side. And then there's pattern trading, which is far too much detail for what you want to achieve with your long-term investment. Okay, where guys look at wedges, triangles, breaks of these things, flags, pennants. It's all very complicated. Heads and shoulders, double tops, double bottoms, triple bottoms. That's too much to understand or too much you need for the investment that you want to make. So what is the best strategy? I think the best strategy is probably one that you can understand. So I'm offering you one that is trade what you see, not what you think. Okay? And you know, when your friend tells you got to buy MTN at the Braai tonight because he's heard something, it's too late. Okay. Now I'm going to show you a couple of simple technical analysis strategies, how to read a chart and what you should be looking for, because this is not rocket science. Okay? A lot of guys look very clever on CNBC on a Monday night with all these fancy charts all over the place. But next Monday night, you will now see what they're looking at. And you will understand, and you will see that they're not so clever. Okay, so your strategy. Now I'm going to give you a couple of ingredients. And the simpler the better, because all you're interested in is, am I going to make money on this investment? And if I'm not, what do I do? So firstly, you've got to understand your time frame. How much return on your investment do you want realistically? Okay, because this market is run by fear and greed, nothing else. Okay, so think about it realistically, and I'll show you how a chart can bring some realism and bring you back to reality on any investment that you have. How much are you prepared to lose is just as important as how much you're prepared to make, because if it goes wrong, that's not the time to panic. That's the time to know exactly what you're going to do. Okay? And charts help you with that. Charts also help you set your entry, your take profit, and your stop loss. This is where I stop losing money. This is where I stop getting punched in the nose. Okay? Technicals will give you these ideas. When you look at a chart, this is brilliant to look at for a novice or a newbie in the market, because charts are a visual representation. You don't have to be clever and analyze everything in your head and do some math. You just need to look at the picture. And if you have a pair of eyes, you'll see the price tells you everything. And then trade liquid instruments. Your charts will tell you that too, which I'll show you. Wait for confirmation of direction. And take profits early if market conditions dictate. Okay, who wants to be caught in a crash? So in other words, I'm going to show you to trade what you see. Right, now you look at your time frame. As I said, charts are a historical representation of what the price has done. Now, history starts a second ago. Okay, so certain time frames might be a minute, an hour, 15 minutes, a day, a week, a month, a quarter, or a year. Now, you guys are not going to be trading every day. You're going to invest in a certain instrument or shares, and you're going to hold them, and hopefully they're going to grow for you. Okay, so you're not interested in the noise in between. So you shouldn't be looking at a daily chart. Okay, you should be looking at a chart that represents a certain period of time. And a weekly chart and a monthly chart stretch back as far as you can imagine. So a weekly chart would probably give you data over the last 2 years. So you can see where you are in this cycle. Okay, so this is probably the most popularly used type of chart that the guys use. And these are called candlesticks. Now, candlesticks were stolen from the Japanese. I think it was around the 1700s. Rice traders used to draw in a diary how much rice they took to the market, how much they sold, how much, what the highest price was that they got for their rice for the day, what was the lowest price, and how much, and they used this to determine how much to bring to the market tomorrow. This was then stolen by the West and predominantly used in currency trading, and then obviously spilled over into every single other investment case or share trading, for example. Okay, so what these candles represent, quite simply, and this is not difficult, guys. This is really easy. Okay, so each one of these blobs or lines is called a candlestick. Now, depending on your time frame, if you were looking, let's say, for example, this was a daily chart. Each candlestick would represent one day. And each candlestick will tell you on that day what the high was, what the low was, where it opened, where it closed, and how much volume traded. Now, this could be anything. This could be an ETF, it could be a share, it could be anything, any instrument. Obviously, similarly, if you were looking at a monthly chart, each candle would contain all the information for that month. So from the 1st to the 30th, exactly all the same information. Easy, eh? Guys, do you understand that though? When you look at one, it contains everything that you want it to. Okay, so in this case, this is a daily chart. It would tell me exactly what happened yesterday. And that's the problem. It told me what happened yesterday. So how much return on investment do you want? Now, this is where charts are really awesome. I look at a chart like this, and let's say we bought it over here somewhere. Now, we think realistically how much you want to make. Let's say the price over here was $100, and it's just come off a high over there. You're going to buy the stock for a return on investment. But any guy or any trader or investor that uses technicals is going to see what happened last time it was up here. Okay, so if you're going to get greedy, 9 out of 10 times you're going to be wrong. And you're going to lose out on all that upside. So realistically, you should be looking at when my investment gets to where it was last time, where that price was last time. Maybe I should just take some profit here, get out and wait for something else. Make sense? Don't wait for new highs. The market doesn't make new highs all the time. I know it's been like that all year, but it doesn't happen all the time. Similarly, how much are you prepared to lose? You buy the same stock. Now, let's say you did make that mistake, because you all will. We bought the stock over here. We got greedy. We didn't take profit. It went back down to where we bought it. And we think, okay, this is it. This is the bottom. Now we're going to get back up there again. And then all of a sudden, it says, no, you're not. Now, that might be as a result of any fundamental or economic news that might have been, if this was a share, it might have been a strike or anything that fundamentally changes how investors feel about that share. So knowing when you're wrong is more important than knowing when you're right. Okay, and this is why you need to set your entries, take profits, and stop losses at exactly the same time. And these charts help you with that. So when I was looking at this chart and I have my Stokvel investment meeting, we all get together and we say, right, guys, this thing's fallen back down to where we bought it. But guys, if this goes any lower, we have to be out. But let's just hold it and see if it goes back up. At least everybody understands, everybody agrees, and you will feel so much better when that share price is 20% lower and you got out roughly about where you bought it. It makes a very big difference because you've then spared yourself all that downside. Very importantly, these candlesticks tell you how much volume a share trades or an instrument trades. And it's important that you trade liquid ones, because as much fun as penny stocks are to trade, for example, they're not always the most liquid. And I'm sure this is not clear, but what this represents is a side-by-side order book during the day. This is the order book for a little company called Sasol. And this is an order book for a little company called Who Cares. And as you can see, this is a snapshot of just a couple of trades that happened between 12 o'clock in the afternoon and 23 minutes past 12. Now, Sasol had done roughly about, 110,000 shares that traded in those few minutes. And from the open, from 9 o'clock in the morning, this little stock had traded nothing. That's not the problem, because there's lots of bid-offer spreads that don't trade until about 12 o'clock. The bid-offer spread, and this is what I mean about liquidity, that can get you into trouble. The bid is at 60 cents. That's the best buyer is prepared to buy at 60 cents only. The best seller is not prepared to sell under R1.50. So your Stokvel investment will shrink by 100% if you cross over the double. 100% if you pay up or you pay down. That's why liquidity is very, very important. And then wait for confirmation of direction. I don't know how many of you have heard the phrase, the trend is your friend, and that most definitely applies to a longer term investment. Guys, this is a visual. You can see it's going up. Okay, and you can draw pretty lines all over these charts if you like, but the bottom line is it's going up. So you will kind of wait for the time when it starts making that rising lows is the kind of share I like to buy and invest in. As long as those lows keep getting higher, that's what I'm going to put my money into. And this is where charting helps you. It's visual. Okay. And then take profits early if you have to. Poor trading updates. Companies come out with bad numbers, bad economic indicators, strikes. Or all of a sudden, the market just sells off and you don't know why. You should probably be getting out too. Okay. And that's why we set those entries and take profits and stop losses. And this is where the charts help you. So here's some technical tools for you. And you don't even need to write this down because this is how easy it is. All you need to know is where does the price get support and where does it find resistance? Where do people start buying it and where do they start selling it? Very important. Trend, as we've seen in the last slide, what direction is the trend? The stochastic oscillator is an indicator of momentum and moving averages, which I'll show you now. So support and resistance, this is a typical example. For some reason, this share always gets bought at around 60 bucks, and at 64 rand, it stops being bought. Guys, just sell it. This is a share that trades in a range, not something you should be looking at because shares can get stuck in a range for very, very long periods of time. Okay, and this is where the original break trade would apply. You would be looking at buying that share if it breaks either up or back down to that bottom, and you try and establish where the stock is going. When it's moving sideways, you're not interested. Okay, and there's another picture of a lovely trend. One of our favorite stocks, Aspen. Those big upward moves normally don't give investors enough of a chance to get in unless you get a very big sell-off. But all I'm trying to get across to you guys is this is all visual. You can see this with your eyes. Okay, you didn't have to go and study for a very long time, and it's not rocket science to understand that a trend is going up. Okay. Then the moving average is very important. Now for you, you need to put in a 200-day moving average because this is a longer-term technical average price of that stock over the last 200 days. Okay, so it takes an average of what the price does every day, divides it by 200 and gives you an average price. But the most significant thing about a 200-day moving average is it tells you how healthy or how sick a share is. Any share that technically trades above this moving average is healthy and strong. If it trades below it, it's sick and weak. You don't want to buy a share that is trading below its 200-day moving average. And then stochastic oscillators. Okay, now this looks complicated, but it's not. All this is a technical momentum indicator that compares a security's closing price to its price range over a given period. But what it does indicate is this part over here is the stochastic oscillator. And it gives you an indication of the momentum of this price. Where does it become overbought? Where does it become oversold? Okay, so normally you would find that when a share has been overbought, it's probably at a high point. These dots all coincide with the highs and the lows. When a share becomes oversold, it's probably at a low point. Okay, now your time frame is important here because a stochastic oscillator changes with the price every single day. And that's why you don't look at a daily chart. You're looking for momentum in growth in a longer term period. So add this indicator to your chart and it calculates it for you. You just tell it, I want a stochastic oscillator. And it plugs it into your chart and it will tell you. And it gives you a nice idea of where you could probably start to look at buying this thing. Because this is where the momentum is. When it stops being oversold, those bottom yellow dots, you don't buy it because it's oversold. You buy it when it stops being oversold. So in other words, when it turns back up. And you're probably going to find yourself hitting that trend more often than not. Okay, so your tools, it's a very empty toolbox this, because technical analysis can be very complicated, and I think a lot of investors, a lot of traders go wrong because they look for too much. Luckily for you, you're longer term investors. Okay, so this is all you need. Trend, support and resistance, that important moving average I told you about, and the momentum, which is the stochastic oscillator. What is the momentum of the price? Okay, now the only time a price gains momentum is when people are buying it. And those are the 4 tools you need when you're looking at charts. So now you can decide for yourself who's buying what brand of 2-minute noodles. This is all it tells you. Some people say you might be herding like sheep, but that's okay because I'm in the market to make money. Okay, so if you're not greedy and you just listen to what the history has told you, the charts don't predict share prices. They give you the history and the direction, and they tell you where things could possibly be going. And when those things change, you must be ready to act on it, and that's where charts are important.